I'm Debra Beck-Mewing from the Property Frontline.
And I'm Gilmovich from Real Property Manager.
And I'm Ken from Avvora Finance. You're with Property Mythbusters. We're here to bust myths around the contradictions and misleading information in the property buying space. And today we'll be discussing the November market update. So jumping straight into the finance space, earlier this month, the RBA have decreased the official cash rate to 0.1%.
Do you want to show that graph?
Yep. So, and this is kind of, I'll bring it up as we just talk. Let's see if I can do this here. And lenders have responded positively to the reduction, and there's also been other things, other government intervention that is also spurring on the reductions in the fixed rates that we're seeing across all lenders. So you can see here, and thanks Deb for adding this graph from CoreLogic. So you can see here over the last, say, 20 years, to give you an idea in terms of the time frames. So over the last 5 years, we're sitting here, and at the moment we're sitting at 0.1%. So we were sitting on 1.5% for a substantial amount of time. But we have since seen steady decreases. So yeah, lenders, you'll probably find that lenders between the 1 and 4 year, even 5 year fixed rates have decreased. There was a lender who decreased a 5 year fixed rate by 1%. So this is more than the drop in the official cash rate. But yeah, from conversations with a financial planner as well, he stated that the government is buying up fixed bonds. So they're kind of trying to moderate the yield curve, and that's helping lenders, offer more competitive interest rates. So that's happening right as we speak. Yeah. If you haven't reviewed your home loan, it's now a good time to kind of check to see whether it is an opportunistic time to kind of switch. I mean, I'm not going to say that you should change just because you should fix your home loan just because the interest rates are low. They are lower than the variable rate, and it'll depend on your circumstances. But if you haven't checked your home loan in 2, 3, 4 years, now would be a good time just to check to see if you should fix. If not, if there are any other variable products out there which are more competitive, then where you can find savings essentially. So the other thing that I'd probably mention with the decreasing interest rates, we're kind of seeing borrowing capacities increase, and there's also kind of loosening up in the credit space in terms of they are talking about putting a shift from the lender's responsibility to make sure that the borrowers can make the home loan repayments, and putting that responsibility back onto the borrower to make sure that they don't take on more debt than they can afford. And that's kind of, that will help ease up the hurdles that you would need to jump through, the amount of documentation and things like that, the forensic accounting that takes place to just check, make sure your living expenses are in line. So the borrowing capacities have increased, but I'm finding that this new kind of limit, which is your debt to income ratio. I have mentioned that a couple of times here in this series, where if your debt to income ratio is basically what the amount of income you're receiving as a ratio to the amount of debt that you had. So if you're earning, as a couple 150,000, lenders are generally okay with 6 times that amount. So to do the numbers, I can't do the numbers too early, but if it's 150,000 multiplied by 6 years, you can borrow approximately 900,000, and that would be kind of your rough limit. So the benchmark is around about 6. If you go beyond that, you might find you have more restrictions with your loan application, such as 75% LVR, which could be an issue if you did need to borrow 80, 85, 90%. Some lenders will go above, and I have seen up to 9 being accepted. So it just depends on which lender, and that's where you can have the conversation. If you are using broker, which is something I would recommend, having a conversation with broker to kind of go through and identify lenders and see, which lender has a credit policy which kind of fits your scenario and would support a home loan application. So that's probably one of the biggest things that have happened over the last over the last few weeks. There's still more to come in terms of the responsible lending and the changes to make, but that's going to be next year. We may have more information come through about that. So that's everything in the credit space.
So money's getting cheaper, Ken. So that's great for purchasing and obviously other things like business as well, to push businesses along. And that seems to be going to be the environment, the low interest rate environment, at least for the next 2-3 years.
Yeah. Okay. Alrighty. So will I jump in now?
Yeah, sure. What's happening over in your space, Deb?
Okay, I'm just going to share my screen. So what's happening in our space, basically the market has just exploded, and I would say it happened in October, and a lot of that is because of just the positivity in the market with the lifting of the COVID restrictions and the government clearly giving signs that they're just going to pour money into the market. But what drives me nuts is that 2 weeks ago, or what, no, just under 2 weeks ago, the RBA dropped the cash rates, and I don't understand why there's such a lag. They're putting, they're inflaming an already overheated market. But looking at the RBA pack, how the RBA puts out their charts every month, they would be looking at this indicator where we can see, looks like the market is still heading down, right? But that's the wrong thing for them to actually consult, and here's hoping they look at more information than that. But basically, as we've talked about many times, this information is about 2 months old, and it's not an indicator of where the market's heading. What we need to do is look at different indicators to tell us what's really happening in the market. And I wonder if you can see this, or if I have to sort of zoom in a little bit. Actually, I don't know if I can zoom in. Oh yeah, zoom, maybe go to like 75. Oh, yeah. Nope. Whoops, sorry.
There is a little plus and minus down the bottom right hand side of that Word doc. You can use that as well. Can you see where it says 75? You press the plus.
Oh yeah?
Yeah, you can drag it. Yeah.
Ooh.
Yeah.
Yeah, so what we're looking at here is another CoreLogic chart. So this is a chart pack that the RBA guys get. And so days on market is the amount of time it takes between when a property is listed and when a property is sold. And we're seeing days on market absolutely start to tank. But this chart alone tells a story. If we look at Sydney for starters, you can see that we're down to 34 days on market generally for Sydney properties to sell, and it's at the exact same spot that it was 12 months ago. And the market, I don't know whether you remember, but we were seeing leaps of 10 to 20% over a 4-week period in October last year. Anyway, so you can see Sydney, same numbers as this time last year. Melbourne, there's 10 extra days, understandably, because they were still in lockdown during October. Brisbane, not too much change. Adelaide, numbers starting to decrease, but look at this. This is the one that we're kind of like I feel like a horse race caller watching this. Perth, their days on market this time last year was 57, and now it's down to 33, like lower than the really hot market of Sydney. So that tells us that more people are buying more more properties being transacted much more quickly. And the other leading indicator that tells us what's going to happen to prices is the vendor discounting. And so that tells a similar tale. So Sydney, it's up a little bit over this time last year. Melbourne, despite the restrictions, is only up a little bit. Brisbane, pretty much like starting to trend down. Adelaide, not too much change, but once again, Perth. So this time last year, vendors were discounting the price. So they put a sale price up and then the percentage that they would discount last year was around about 4.7 or 5%. But in October, they're down to nearly flat out 3%. Might not sound like much of a change, but that's actually a huge, huge trend. And the real story can be seen from this. I'll just zoom out just a tiny bit. So this chart tracks the change in pricing. So for each capital city, the starting point was set at whatever their prices were for March, and we can see a notable even flattening of the trend in Melbourne. Oh, sorry, just explain. So this only tracks prices from March to October, but what happened to those prices? And so we can see Melbourne starting to flatten, Perth really starting to rise. But basically, like they say here, there's a more broad-based upswing, which is becoming evident. But you can't see it when you take that longer view. I'll just scroll back up here. So I hope that the RBA guys are not just looking at that and pouring more money into the market, because we don't need it. We don't need it for the housing market in particular, units maybe. But anyway, so that's me for that's me panicking, because I'm the one that's going to have to like sharpen up my elbows to get good prices for my clients and actually grab properties for my clients, because it's going to be definitely a seller's market from here on in. Okay.
I was going to ask you, Deb, real quick. Have you seen there been any shortages in or reluctance or vendors considering whether they should, put their properties on the market, and issues with stock level and things like that? Have you seen an improvement in the number of like properties out in the market space and things like that? Because when I was out with the agent, there was a period of time where it was there weren't a lot of new properties coming on the market. Are you kind of seeing any changes there, or?
Stock levels are still quite tight. So, and this time of year, we wouldn't expect to see much more stock coming onto the market, because people will be holding off until January.
Yeah. Okay. That makes sense. All right.
Okay, Don. Over to you.
I'm with you. Okay, so let's have a look at the rental market and rental reports. I'll just bring up some points and data around that as well. So the rental market, can you see that okay?
Yep, it's words, not chart. Yeah.
Yeah. So the rental market theme, I guess, continues to be, around the song remains the same, really, that famous song. It's pretty much since March and COVID hit and borders have shut down. We have an oversupply situation in most capital cities. But this is for the apartment market, so the strata, mainly the strata apartment market, where you have the oversupply, and it continues to show in the statistics that there is this disparity between the house rents, which have actually risen in some cases, because that's the lack of stock.
Yeah.
But high demand, where the unit rents are down. So you can see that these are stats of CoreLogic, by the way, and in particular, you know, the two main capital cities, Sydney and Melbourne. Overall unit rents are down around about the 5% mark. That's broadly speaking across the city metropolitan areas, but not so much with the houses. As you can see, they're 1.3% and 1% respectively. But of course, in some suburbs, we know, and we have covered this over several months now, that there are certain pockets of suburbs that are in more extreme cases than others as far as vacancy rates. And it seems to be that the more inner city markets, including the CBDs themselves, is where there is just an influx of stock level, and especially the apartments. And when you think about it, basically the CBD workers, okay, they're generally, and the demographic around the inner city suburbs, like for example Sydney's Darlinghurst, Pyrmont, Surrey Hills, where there's a large concentration of hospitality workers, CBD workers, IT workers, lots of students, and they're basically in that kind of 25 to 35 age gap, where they're likely to be renting their first home, and that being an apartment. Well, they've moved out. They've now moved out, moved back home, moved interstate where they could, or basically have stayed where they are and reduced their rents, and negotiated with their landlords, because we still have a rental moratorium in place across nearly all of our states. So the power is still with the tenants at the moment to negotiate on that front, best outcomes, and of course the leverage is still there for any tenants that are out there looking for rental property to negotiate pretty hard on the current asking rents. Mainly, the main issue at the moment for investors, and this, we're obviously in a low yield environment right now for rental property, and so you will see a lot of investors exiting or not moving to purchase right now, because we are likely to stay in a low rental yield environment for the next 2 to 3 years, until possibly the gates open up to international travel. And you can see by the ABS graphs here that I have how much of a sharp fall, and you can see it's every 2 years, how steady it's been rising, but then there's a massive sharp fall, and this is August 2020, of short-term and short-term visitors coming into Australia, where basically these are residents and short-term visitors, holiday visitors, down dramatically. So the rental market is subdued because we're just not getting enough people in our capital cities that are travelling from overseas and taking up the mass accommodation that's basically available in the inner city markets. And until there's a relaxation on the borders and international travels, including the students and skilled workers, the rental market is going to be in a bit of a free fall. It will continue. It may continue to fall on rent valleys, and that means the yields are going to be low. So not great news for investors. So you can see there Yeah, especially the units. If you do own a strata apartment right now in the inner city markets, I can feel your pain because yeah, the rents are tumbling there.
But I wonder how long it will last, given that there's a vaccine announcement. And I read an article in the AFR where they said there's about 430,000 expats have come back, and they're actually starting to buy property. And there's also this theory, unproven, that Australia is looking more and more attractive because of the way the government has handled the whole situation, and because this increase in distance working, that we might have like a really big influx very soon.
Yeah, good point, Deborah. And no doubt, Australia is being watched from abroad in how we handled the pandemic. And look, after all, not dissimilar to New Zealand, we are an isolated island. So we knew
it'd come in handy.
Yeah, we're very fortunate in that sense that we have more control over the borders and of course travel and those bringing in COVID into the country. So, but we are and have been historically a great place to invest in from property and business, and that is likely to continue. But the key to any growth in our nation is going to be the immigration levels, which are very, very subdued at the moment, and travel. And so here's the CoreLogic up-to-date report. Yep, we've got an elbow here. So this was a screenshot from a video. I didn't want to go into a long video, but that's where we are at around the country from change in the rental prices. And there you can see the disparity between the houses and the apartments on the percentages. And you can also see there the disparity of the continuing trend of regional living.
Yeah.
So look at the vacancy rates there. It's pretty low in most of our major capital regional areas.
This is just rents.
Sorry, the rent prices.
Yeah.
They haven't come off that much.
And look at Perth.
Less than 2%.
Look, Perth is really starting to stand up, isn't it?
Yeah. Yeah. So it's now purely a lifestyle choice that you don't have to commute to the city. You don't have to live in the city and have the high cost of living when you can live further out or go live regionally, still be able to have a job and function as you would normally do, because a lot of corporations and large, small, medium enterprises are still now more comfortable than ever with allowing their staff to work from home. So why pay all that thousands and thousands of dollars in rent in the inner city where you don't have to commute to the office any longer or only a few days a week? So this is a trend that's likely to continue, Deborah, until the international travel situation changes. Because I saw some stats around how much travel has just gone. Oh, sorry, migration has gone down from something like 260,000 immigrants coming into Australia from 2 years ago, and it's predicted that it'll only be around about 35,000 for next year.
Yeah.
That's going to play a key role.
And I wonder if this will be like a step change, another, like a working from home age.
Yeah.
You know what I mean?
Start the workforce. A quick question, John. Are you seeing like the rents kind of stabilize, and have they kind of found the bottom yet, or are they kind of still decreasing? Like what's
yeah, so what I'm continuing to see, Ken, is anything that's coming back on the market from, say, last year, so those leases that are expired and tenants are now moving on, I'm still seeing rentals drop for relets, for the relettings. So the open houses, they're not greatly attended. The numbers are down. So we used to say get at least 10 to 15 attendees at an open home on a typical Saturday. Just not seeing that. It's now 0, maybe 1 or 2 coming into apartments. And if it's a house, you may get into double digits where you have, you know, between, you could have 10 people inspecting a nice house in a nice area, because they're the ones that are in demand. You know, strata living has its positives, but in a COVID environment, it does have a lot of negatives as well. People want to be a little bit more isolated. They still want their kids running around in the backyards for families, and that's telling in the statistics.
Yeah. Okay.
So that's the rental market, looking like that situation will continue, and we'll keep you posted. So Deborah, that's all from me, and we'll wrap it up now. And thank you for listening to this session. And of course, join us on Property Mythbusters Facebook page to watch all our video recordings. If you have anything you want us to cover, please shout out to us through our channels. We would love to take any challenges that you throw at us, or any particular topic you want us to cover, plus any guest speaker you might want to for us to bring in, any experts in a particular area. And Deborah, by the way, and Ken, we've got depreciation, the myth of depreciation schedules in our next fortnight's session, and we're bringing in an expert in that field to discuss the benefit of property depreciation when you're purchasing. So
as well as the traps.
As well as the traps. So looking forward to that. And thank you once again for joining us, and we'll see you at the next session.
Okay, thanks.
Thanks.
Okay.